Welcome to the Earn Your Marks podcast, presented by Pro Exam Tutors, the only podcast you need to pass the CFP exam and become a certified financial planner professional. Here's your host, Sev Meneshian.
Welcome to the Earn Your Marks podcast. I'm Sev Meneshian, certified financial planner, practitioner, lead tutor, and the founder of Pro Exam Tutors. In this episode, I'm going to talk about some of the things that will be tested as far as the retirement planning module is concerned. Now, first of all, for many candidates, and I was one of these people back when I was going through the rigors of studying for the CFP exam, the retirement planning portion, it's very challenging, and it's understandable why that is. After all, most of us don't come from a retirement plan admin background, so things like a Form 5500 or private letter ruling are things that we ordinarily don't have to contend with. Regardless, CFP board is very interested in testing your knowledge on a wide range of these and related topics. So, you've got to be prepared. It's as simple as that. Now, some of the topics we'll cover today are IRAs, qualified versus non-qualified plans, funding formulas, what that means, corrections for overfunding plans. And speaking of plans, you'll need to know a lot about the different types of deferred contribution and defined benefit plans that are out there as well. You'll be asked to do a retirement plan needs analysis, and it could be something like, Joe, the business owner, is 50 years old, owns a business. It's him, his wife, and a lot of younger workers. What type of plan should they put into place? So that's the type of question that you can, or the sort of topic that you can be expected to be tested on. Don't forget your plan distributions, especially when it comes time to take money out due to death. Those things can be a little bit tricky. Why? Because we're dealing with a retirement planning issue. yes, we're also dealing with an income tax issue there as well. So, you'll be asked to differentiate, or not differentiate, but to know what are the tax consequences if I take a distribution from an IRA or a retirement plan, and it's just a normal distribution. Will there be a penalty? Well, sometimes there will be. Now, will there be taxes? Depends. All right. So it's going to get a little bit tricky, but I'm going to help you with those areas. And then I have obviously other videos and blog posts relating to those topics. Now, first thing where I would start in your retirement planning module studying journey is to know the difference, or I should say not know the difference, but to know the background just a little bit. And that little part is it's not a small thing as far as the law is concerned. It's the ERISA law, Employee Retirement Income Security Act of 1970 something. I thought it was 74, but for some reason I'm thinking 1978. I should know this obviously because I was driving behind somebody in a very nice car whose license plates were ERISA. I think it is actually 1978. I'll do a quick check, or one of you guys do that. But I remember seeing that license plate, and I go, okay, this person has to have some sort of tie into ERISA plan. So anyway, learning the background of ERISA, why it came about, the laws and the rules and so on, that will be helpful. Now, what also will be helpful is, since ERISA oversees most types of retirement plans, we want to split these two types of plans, into two general categories. Okay, so we're going to have like a general category of ERISA. That's like everything falls, or mostly everything falls under ERISA. We have our qualified plans in one column, and then we have our non-qualified plans in another column. Now, if we can take the qualified plan column just for a minute and then now further split that into two categories, then what we're looking at there, as far as our subcategories, are defined benefit plans and then defined contribution plan, DB plans and DC plans. And we need to know the differences between those two. Now, under your defined benefit plans category, you're really just looking at four types of plans. I won't list them out here right now. Those I know it's in your study material. And then if you look at your defined contribution plans, there you have over a dozen of those type of plans. Now, I don't want to scare you off by saying, well, we have only over a dozen plans that we have to know about. But I mean, you just have to know a decent amount regarding those 12 plus plans, and you'll be fine. It's not the end of the world having to remember all of those. So what we're going to know, though, is we're going to be very interested in the tax characteristics of the money going in and then the money coming out. What are the tax consequences to the employer? Does the employer get an immediate tax deduction? Most of the time, that's what they're looking for. So most of the time, the employer is going to have in some type of retirement plan that is probably on the qualified side. Now, when I say the word qualified, what am I referring to? I'm referring to qualifying for special tax for a special tax status under the ERISA law. Okay, so if I am, as the employer, I decide I'm going to put in let's just say a defined benefit pension plan, what I'm looking for, well, why did I put that into place? Why did I put that into place? First of all, I put it into place because I want to attract employees. I want to retain them. I want to make sure that they're happy, that they're going to stick around. Okay, now, if I put in a defined benefit pension plan, that's probably what's going to be the end result as far as my employees are concerned. Now, the additional benefit that I get from it is from putting in a pension plan is that, well, all the money that I'm dumping in as the employer, I do get an immediate tax deduction. As opposed to other types of plans where I don't get a tax deduction up front. In fact, I'm going to get that tax deduction down the road at some point when something happens. And that something is typically when the employee takes the distribution from the plan. Okay, now there we're talking about like a non-qualified retirement plan where the employer still wants to attract, wants to retain employees, but is not so much interested as getting that immediate tax deduction. All right, and there are a few other reasons that we're going to put that type of plan into place, which we won't get into today due to the limited time. But I hope what you see or hear what's going on right now is that I'm explaining different plans to you. And in the opening statement that I made, I said that one of the things that you guys are going to have to know is what type of retirement plan is an employer going to put in based on the circumstances of the employer. Okay, so we want to pay attention to our pension plans, qualified plans, non-qualified plans. Now, other types of plans that we have too are like profit sharing plans. I mentioned defined contribution plans and what are the characteristics there. Okay, so we could have a plan like an employee stock ownership plan or just a traditional defined contribution plan and what that entails. We also have different categories under our tax advantaged and non-qualified plans, which I mentioned before. So your tax advantage plans, and you don't have to get like too specific with these. I mean, you can just put things like simple plans, 403Bs, 457s under that category. Now, where you want to watch out as far as exam questions are concerned is you also want to have a cheat sheet that will detail the maximum dollar amounts that can be funded, let's say into a simple or a 403B or a 457 or 401k profit sharing plan. By the way, keep in mind, like a 401k, it's a section of the code that you almost attach on as a rider, if you will. Okay, the 401k actually attaches itself to a profit sharing plan. So the profit sharing plan is the chassis, or it's the body, and it allows for employer contributions to go in pre-tax. And then the 401k portion allows for employee contributions also to go in pre-tax if the employee chooses. Now, you can make after-tax contributions to a 401k. If you have a designated Roth account, the plan sponsor will have that set up and will make that known to the employees. Okay, so once again, now what are we seeing? Now I've started talking about some of the tax consequences, or I've expounded on the tax consequences in different plans. And you can probably realize at this point, this is why I said in the beginning, is that the retirement planning section proves to be one of the more challenging parts of the CFP exam. Okay, now it takes up the most space, if you will, but there's a reason for that, because there's just a lot of twists and turns, a lot of tax questions, a lot of distributions. How much can I contribute to my IRA? What if I make too much? What if I make an amount where I can put into my IRA, but not the maximum amount that I wanted to? Okay, what if I'm age 50? Can I put away more into an IRA? What if I'm not age 50, but I turn age 50, I don't know, on December 31st of the year? Can I make that age 50 bonus? How much can I put into a profit sharing plan? Is there a limit there? How about into a defined benefit plan? Is there a hard dollar limit that I, as the employer or the employer, can put into a defined benefit plan? And there's really no hard dollar limit there. But if we're dealing with a defined contribution plan, there certainly is a hard limit. Okay, so again, the retirement planning section, as interesting as it is, my assumption is for most of you that are listening, is that this will be almost right up there as far as the degree of difficulty that you'll find with income tax planning. And why? Because most of us don't come from an income tax planning background. So if you're, like I was when I was studying, the only exposure really that I had to income taxation was, like doing my own taxes. Okay, that was about it. And that was before I had ventured off on my own with my own planning practice, where, with my planning practice, obviously I'm looking at income tax returns and tax consequences of certain maneuvers and trades and what have you, on a fairly regular basis. One subject I'll lump into one, but are traditional and Roth IRAs. Those two you have to have down. You just have to have those down cold. And then your planned distributions, well, that's all about taxation. Obviously, the rules as far as the plan document is concerned. And what I would encourage you to do is, since you have to know a lot also about Social Security, if you're not already dealing with that with your own practice or whatever group that you're with, if that's where you are in your career, what I would suggest doing is you start reading through the Social Security website. It's an excellent website. It's actually written in plain English, which is quite surprising. Okay, so I'll encourage all students to go to the Social Security website and poke around with your own numbers too. You can request a report and see how much you're going to get, and what your primary insurance amount is, and what age that you can take full benefits at. You can take your own Social Security report and say, okay, well, what if I go before age 67? If I retire at age 62 or something, then what's going to be the haircut? What's going to be the lowering of my benefits? Will those benefits be permanent, or do I Do I kind of get those things back later? What if I'm working at age 65 and I decide to start taking my benefits, but I'm making too much? Okay, do I still get a benefit? Are my benefits once again going to be cut permanently? Okay, so those things are a way, to mess around with the Social Security website, and then your own report, or maybe for mom or dad or aunt, uncle, whomever. It's a good way to learn, certainly a good way to learn that information. And lastly, like I said, that we have to know, or you have to know the difference, what retirement plan is going to be the best solution for the particular client in the case study, or the outright question that you're going to see. And I wish I had an easy way for you to remember the differences between all the different plans. And there are some shortcuts to remembering certain things. Okay, but a lot of it just has to do with the reading and the repetition, and really not going on to the next topic before you understand that retirement plan fully. And there are a lot of resources out there that can also give you a different view of things, one of which I gave you, which is the Social Security website. Okay, so that's what I have to offer so far as today, as far as the retirement planning module is concerned. And just as usual, studying for the CFP exam, it's a major commitment, so make sure that you're hitting the books, that you're doing a lot of practice questions. By the way, we have a question bank, or a Q bank, with over 4,000 CFP exam questions, and these are adaptive questions. That means that they're personalized, based on your performance. So if you're weak in one area, then the Q bank is going to support that area. If you're very strong in one area, then you're not going to see it so much in the way of questions, or you might see a lot more difficult questions if you're strong in one area. Okay, and so lots of practice questions, as I mentioned, that you can do with us. And if you haven't done so already, subscribe to our YouTube channel at Pro Exam Tutors for videos on other tips and topics, which I post regularly. And if you find this information helpful, please let me know with a like and a comment. I always love hearing from you guys. And I even more, I love hearing that you guys have passed the exam. And if you know someone or a study group that can benefit from this knowledge, please be kind by sharing this information with them. Thanks again. Have a good day.
Thanks for listening to this episode of the Earn Your Marks podcast. For more information or to get in touch, visit us at proexamtutors.com.